sharp rise in U.S. Treasury yields on May 21, 2025, pressured Bitcoin yields and major altcoins immediately. The 10-year bond yield surged to 4.5%, while the 30-year reached 5.09%, disrupting global crypto markets. Institutional and retail investors reacted swiftly, adjusting strategies focused on Bitcoin yields and crypto interest opportunities. Higher Treasury yields often signal tighter liquidity, increasing borrowing costs and investor risk aversion. In this environment, Bitcoin yields and altcoin prices face downward pressure as capital shifts toward safer assets. Previous cycles showed rising bond yields correlate strongly with outflows from decentralized finance, DeFi lending, liquidity mining, and other speculative crypto sectors. Data indicates elevated trading volumes on major exchanges like Coinbase and Kraken, reflecting Bitcoin and Ethereum trades amid these market shifts. This interplay highlights how fiscal policy nuances impact Bitcoin yields, staking rewards, and overall crypto market volatility. Experts expect U.S. Treasury yields have room to decline, potentially boosting Bitcoin yields and risk on assets again. When yields fall, liquidity improves, encouraging crypto staking, yield farming, and rising investor appetite for BTC rewards. This scenario could trigger rebounds in altcoins like Solana and Cardano, thriving on crypto dividends and passive income incentives. Tracking Bitcoin yields remains crucial, as modest drops may ignite strong rallies in BTC staking and interest accounts. Institutional capital flows reveal key insights during yield changes, with large players retracting riskier holdings like Bitcoin lending as yields climb. Firms such as MicroStrategy adjust Bitcoin yields exposure accordingly, affecting market psychology and retail trading behaviors. Yield increases drive volatility, prompting short-term trading surges and higher transaction volumes in crypto yield markets. Coinbase and Kraken reported significant activity spikes after yield announcements, showing reactive repositioning across yield aggregators and derivatives. Bitcoin and Ethereum experienced heightened spot trading, underscoring their dominant roles amid macroeconomic shifts. Stablecoins gained prominence as safe havens during yield volatility, absorbing significant crypto interest flows while traders minimize risks staying within the ecosystem. Understanding stablecoins' roles in liquidity mining cycles is vital, as they stabilize or magnify price swings linked to Bitcoin yields. Analysts predict easing Treasury yields and sustainable fiscal policies may rejuvenate risk-on sentiment in crypto staking and yield farming sectors. Lower yields tend to draw capital into high-volatility digital assets, fueling fresh rallies in Bitcoin yields and crypto dividends. This outlook urges vigilance among investors tracking interest accounts and passive income streams within decentralized finance lending platforms. Anticipating yield movements supports strategic choices in the evolving 2025 crypto landscape, optimizing BTC staking and Bitcoin lending returns. Before exploring further, liking and subscribing supports ongoing analysis of Bitcoin yields and market updates. Your engagement helps examine Treasury yield impacts on staking rewards, crypto interest, and liquidity mining trends. Consider how persistent yield volatility affects decentralized finance lending dynamics and crypto staking incentives. Will continuous fluctuations alter passive income prospects in Bitcoin yields or yield aggregator platforms? These questions remain central to navigating today's crypto yield environments. In conclusion, soaring U.S. Treasury yields pressured Bitcoin yields, disrupted investor strategies, and boosted trading volumes significantly. The link between rising yields and crypto yield outflows reveals the interconnected nature of traditional finance and digital assets. Potential Treasury yield declines offer hope for renewed risk appetite and stronger BTC rewards ahead. Staying informed on macro trends involving Bitcoin yields and crypto interest empowers smarter investment moves. The evolving bond-crypto yield relationship will define 2025's narrative around passive income, staking rewards, and yield farming opportunities.